Okay. All right, everyone. Welcome to our meetup. Thanks so much for taking time out of your evening to make it here. My name is Santhosh, and this is Layne. We're going to talk a little bit about what's driving the Calgary real estate market, explain some of the underlying factors as to why the market is so hot the way it is. Right. So there's organizers. That's me right there, and Anthony couldn't be here today because he's on vacation. And we have Layne. So Layne's a mortgage broker. Myself and Anthony were investor-focused realtors. So before we begin, this presentation is only for informational purposes. Don't take this as investment advice. Keep your own professional advice. Solicitation. So we understand there might be other realtors here, mortgage brokers, other industry professionals. We welcome you to this event. However, make sure you're not handing out your business cards because these events are not free to host. They do cost us money. So we appreciate your cooperation. All right, so let's get started. So what's on the news? So these are all from the last few weeks, right? Pretty typical news headlines that we can see today. Home prices are soaring despite higher interest rates. Benchmark prices are going up. Calgary is not following the trend as of the rest of Canada, but we're deferring from the trend and why the city is booming, right? Some quick stats. These are July 2023 stats from the Calgary Real Estate Board. And you'll see, right here, you'll see that our detached price year over year has gone up 8% almost. And you'll see that the hottest segments right now are your row houses or townhouses and your apartments. So year over year, these are pretty significant gains, right? And the reason why, part of the reason why, is look at our inventory here. Year over year, we're down almost 35% in inventory. And it's not as if last July inventory was great and we're only down 35. It was already terrible last July to begin with. Okay, so the problem just got worse. And our months of supply is also down almost 45%. But to kind of add fuel to the fire, our sales numbers are up 20%. So there's a lot more activity and very little inventory. Okay, so that's kind of fueling the fire right now. So as far as inventory goes, you can look at our July 2023, and this data goes all the way from 2009. Every single July. And we're actually at our lowest point since 2006. So there's barely anything on the market. If you're ever in the market currently, if you browse MLS, you'll see that there's almost nothing to choose from. Okay. So that being said, let's go on to benchmark home prices. Now if we look at Calgary here, the blue line, right there, compared to the rest of Canada or the major cities, Vancouver, Toronto, which is right there, we are still relatively quite affordable, okay? And the rest of Canada is right there. So we're still affordable compared to the rest of Canada, lower than that. So I'll hand it off to Layne, and Layne's gonna continue on the rest of the presentation.
Yeah, so as Santhosh said, it's pretty unofficial tonight. We just grabbed some headlines, but really and talk about why those are, why those are important. Two of the biggest fundamentals that I talk about, we talk about the one which is the supply versus demand and the impact on inventory. So obviously, the combination of those things to a lack of supply and an increased demand obviously causes price to go up. But there is the tulip frenzy version of that where that can cause prices to get out of line with reality or with basic underlying fundamentals. Now, the problem in Toronto and Vancouver is it's been a long time since that's been the case. It's arguably 15 years if you look back. So if you look back in here, this is the Toronto. The Toronto is right there. Vancouver, it's always been overpriced, and this always will be. They have mountains and they have water. They have a geographical restriction. Toronto has a self-imposed geographical restriction in the green belt. So if you ever look at the city of Toronto, you've got a green belt that kind of goes around the city, and you're not allowed to build on they just kind of put a board there and said, you can't go past this. This is the green belt, it's a park. But there's been a push to say, okay, well, we should, as long as we're adding to the other side of the park and making the park bigger, we should be able to develop certain areas on the city side of the park. And there was a big backlash 5-6 years ago when they tried to do that. And now with affordability so far out of line, even the federal government pushing for it is likely going to happen. Government, bureaucrats, every level of government know it needs to happen. It's just unpopular, but now it's such a big push for affordability. We're probably going to see some of that. So their self-imposed geographical border might get back in line. But even so, when you still look at Toronto, even where it was here, similar price to Calgary. But then, you see it's, 2.5 times the price, or 2 times the price for, and Calgary, the blue line here, we just barely, until 2020. So from 2007 till 2020, our prices basically hadn't moved. And this isn't taking inflation into account. So our prices, in terms of value, have actually dropped. So only recently have we had any kind of increase in price from this mark here. So when you look at 2007 prices, we're not very far up if you take that over a 15-year period. It just happens to be that that's also a 2-year period. So it's just really the only time we've had a price. So when people talk about even Calgary's having excessive price increases and it's not sustainable, well, overall it isn't sustainable. If you've already been doing this and then you get a big jack up in prices, not sustainable. But since we've had, during this entire time, incomes went up, but our house prices didn't. So this is all over a 15-year period. So we've got, one of the stats that came out that was 3 weeks ago, we have the 27th most expensive rent prices in Canada. So we should be number one because we have the highest income on median measures, average measures. We have the highest income in Canada, but we have the 27th highest rent. So if you actually counted affordability and our incomes in comparison, I don't even know if we make the top 50. So we're very affordable in terms of rent, very affordable in terms of pricing. And that's an underlying fundamental that supports. So even if a correction happens or things flatten out a little bit, we've got a lot of cushion. We can absorb a lot more than they get. It doesn't mean it's not, what it's like. I'm a mortgage firm as a realtor. It's hard to get people qualified right now. So it impacts us, but it impacts Toronto, Vancouver so much more. They become such a bigger part of the overall Canadian real estate market that it also creates a kind of a top-end limit of what the federal government or the Bank of Canada can do to suppress the market. Because by the time they suppress it enough to really impact us here in a way where people wouldn't be able to make payments, it would have crushed those markets. And no government's ever won an election without the GTA or a good portion of it, so it's never going to happen. They'll always protect Toronto. So if things start getting bad there, they'll slow things down. They'll support the real estate market, and they'll do that by way of inflation. They'll inflate debt away because they want to inflate their own debt away. They'll help people deal with it by inflation, and ultimately that's good for real estate investors. And for us, we're still in a market that's largely affordable. So one of the things that obviously impacts supply demand is immigration. So international migration, I think everybody knows Canada accepted 1 million people last year, on pace for doing the same this year, and then we're going to slow it down to 500,000, which is about 70% more than we're typically used to or set up for. So we not only have an inventory problem across the country, it's going to be a long time. But then you look specifically in Alberta, this is the international, this is international migration, this is the interprovincial. So these are people from other parts of the country moving to Alberta. So that's a net number. So we might have had 30,000 people move out and 49,000 people move here. So that's the net number. That's not a year, that's 1 quarter. So when you look at these numbers here, that's you're basically going to times that by 4 for what we're on pace for. I don't know that it will last this long at these levels, but even half these levels is higher than we're used to, and it's also higher than we have the capacity to build for. We don't have what happened in 2015 when our market did crash, but we had a lot of builders, we had a lot of electricians, drywallers, plumbers, framers, general tradespeople. Over a 6-7 year period, as our economy started to diversify into other things, those people stopped doing that stuff. There wasn't enough work for them. So now the problem that we have is now that we've ramped up demand, we don't have the tradespeople for it. So we're out of trades, the city can't keep up with the permits. If everything worked out perfectly, it would take, and immigration slowed down, it would take 3 years to catch up. And that's unlikely to happen with both interprovincial migration as well as the international migration continuing to stay high. This is broken down by age. One of the things that I like to see is the younger, like these two are the people that actually fill up the workforce, and it's we do have a younger population. We have the youngest population in Canada by quite a ways. That brings both people who, some of this 25 to 35 to 44, people in that age range don't absorb a lot, whether it be from the healthcare system. They're typically contributors, so they're not going to school still, so they're no longer supported in school. They're not yet needing a lot of medical attention. So given that we have high interprovincial migration of people moving to Canada in that age bracket, it brings a lot of innovation because they're younger, but it also ultimately is good for our economy, filling jobs and producing. So our GDP is expected to continue to outpace the rest of the country. If you look at every projection along this track here, all the different ones, Alberta's outperforming in every area. Here it's just the different particular growth rates projected. And this is so the Conference Board of Canada, ATB, Canadian Taxpayers Federation, they all had this, that there's no scenario in which Alberta isn't going to outperform the rest of the country in almost every metrics. And when the eventual recession that the Bank of Canada is trying to force does hit the rest of the country, however that happens to look, I haven't seen a scenario where Alberta's been included in that. So even if they're successful at creating the recession to slow down inflation, it won't happen in Alberta, or at least that's the projection. Population growth by age, same thing. We're just by every age metrics, we're just having a higher population growth. This one in particular is higher just because we don't have many old people by comparison. I don't think we have this stat in here, but our per 100,000 people, I think the average in Canada was in the 150-ish range per 100,000 people in terms of how many births. And we had, and we're at like 389, so we're almost 3 times the birth rate of Canada, which again is younger growing families, so that's increase in GDP, and again, a younger, more innovative economy and workforce. And then this is reflected in the job numbers. The most recent job numbers actually show, it doesn't say this here, but the most recent job numbers actually show Canada lost jobs as a whole, Alberta gained jobs, 5,000 net, but it was actually a loss of 10,000 part-time jobs and a gain of 15,000 full-time jobs. So not just a 5,000 increase, it was actually an increasing quality of jobs as well. So now it's been about 16 months that Alberta's outpaced the rest of the country in increased job growth, and again, that's one of the things driving interprovincial migration. Along with that, and then the fact that a family can afford an $800,000 one or two bedroom condo in Toronto, or they can afford a $650,000 or $700,000 house with a yard, and they can raise a family here. So we are getting a lot of it. That's not from my anecdotal experience, but also statistically, we're seeing lots of people move out here because they can. If they can work remotely for their employer in Toronto or find a job out here doing the same thing, they're moving here because the lifestyle they can get is significantly better here. This one, I'm not even sure why I threw this in. I don't even like to. Oil's important to Alberta, but it's more important to the government of Alberta than it is the jobs, particularly in Calgary. From 2015 until now, I think our stats are we were 24% of our economy really came from oil and gas. Now it's down to about 19, but that's an Alberta number. A lot of the other growth sectors, I would say, are mostly in Calgary. Everything from film to fintech to all the different, we get the biggest proportion of that. So I'd say Calgary in itself has probably been better than those statistics. Again, great for the government for royalties, but our economy isn't, in terms of the employment, it's not based on the oil and gas revenues, it's based on the increasing production of oil and gas. So we have incremental production, increased production based on projects that are already in place and slowly improving. That's great for the government, good for tax dollars, but it's not what's creating our employment. This stat's now a little bit old. I wish I could get the updated ones, but a little over a year ago, our capex, or capital expenditures in oil and gas, were actually below 2019 numbers. So this is what everyone across the country, or the CBC, or anybody lazy said, well, oil prices are up, so Alberta's doing good again. And it's like, well, that's not where our employment's coming from. Our employment's up for other sectors. Our oil and gas expenditures are actually lower. So there's less jobs, less investment going into it. The jobs are coming from other sectors. Again, oil and gas is great, and it actually has had an increase now. So I think we're a ways above 2019 levels, but that's not where our growth's been coming from. So I do think that's good for us. In particular, this chart does talk about the difference between the spread between the Western Canadian Select and WTI, which is what most people know as the kind of the benchmark for oil and gas. And you can see there's always a spread. And this only goes back to this year, so the spread could get quite large. I mean, you can here's pretty big difference. But in spite of everything the federal government's doing to suppress Alberta, there's not, once the Trans Mountain comes on, there's going to be a lot of excess capacity. Plus, we're going to have the natural gas pipeline for liquefied natural gas done. Actually expect the spread here, that has nothing to do with the LNG, but the Trans-Canada Mountain one, when that comes on next year, that's probably going to reduce the spread quite a bit, because we'll be able to sell directly to Asian markets instead of through the United States to Asian markets. So ultimately still good for the government, not necessarily directly for employment, but it's still good to have a government that has excess money to spend on things and doesn't have to tighten things up. The employment numbers, we've already really touched on most of this. You can see the spread. This goes back to 2019. Obviously, this is COVID. But over the last since things normalized about a year ago, Canada's done pretty well. Alberta seems to be still just doing better. These rates aren't impacting us in the same way.
That's about it for
Yeah.
today.
Yeah, that's about it. But I'd say if you want to, I encourage you guys to ask about the things that concern you the most. The biggest concern that I would have is what can I was trying to think of okay, what could be a potential negative for us? Obviously, oil crash would help, but it would hurt as much as 2014, 15, or 2007, 8. I would say that the federal government trying to hurt Alberta specifically for election purposes, but I think they're already doing a lot of that, and it's not having much of an impact. Trying to think of what else could be a negative for us, and I just think because our market's been so suppressed, when you look at those benchmark prices,
Still have a long ways to go.
it's just, we've got a lot of room. We've got a younger population, more educated population. Calgary is the most educated population in the country. Growing kind of industries, everything. We have the de Havilland decided to build their airplane research and manufacturing plant, including a new airstrip and everything just east of the city. It's just almost a strange thing for a company to do, is to decide to go across the country from where manufacturing is done and manufacture new research and development in Calgary. Again, right to the point where it's large enough that they're building an airstrip as part of their testing facility next to one of the largest, one of the largest existing, terminals in North America. Actually, Calgary is way overbuilt in terms of its airport capacity and logistics capacity. So we've just got all of these things that are going good for us. So I struggle to try and figure out what could go wrong. I'm usually pretty pessimistic, and I try and hedge. Like, I have a portfolio of real estate. I'm always hedging with the worst case scenarios. Obviously, interest rates hurt, but I think there's a cap on what can happen because of the rest of the country being so expensive compared to us. So I really don't know. What do you guys have concerns about? Or do you guys have any questions or comments about this? Alan, you always. Yeah.
Because sometimes I think about the interest rates, right? Like, if a lot of people are locked in, even in Toronto and other places, right? Like, it may still take like a couple of years until we have that, and like maybe they're gonna keep stretching and increasing. And then when they know, okay, like the percentage is starting crazy, let's just drop those rates as fast as you can. Like, I don't know.
Eventually, I think we're going to get to that, because that's a good point. Is that a lot of people will say, even our economists saying this, it will take 18 months for an interest rate to take full effect, and that makes sense in the U.S. because they when you get a 25-year mortgage in the U.S., it's 25 years amortizing, and it's a 25-year term. You get the same rate for 25 years. Here, everybody gets 5 years. Not everybody, but 95% plus. So which is good. The Bank of Canada has more tools, because when they increase rates, everybody starts paying it. So it has an impact both faster and longer. So the US knows that they can't impact existing mortgage portfolios, so they can only stop new mortgages and slow the economy that way. So they have to raise more aggressively. Whereas in Canada, we can raise less aggressively, though we haven't. But then you've got to wait the 5 years. We're not even a full year into the biggest increases. We still have 3 more increases. So last September, I think it was 50, and then October was 50, and then December was 75. So 1.75 of the largest increases until we get until they pause was a full, we're not even a year into a full increase. So when you took a look at a 5-year turnover rate, most people haven't hit that yet. So we're not even and the people who have, even if they were in the leading edge of that, they didn't get the full increase. So they might have renewed into 4.3 from a 2 point something. But they also might have had some savings saved up. So there's a little bit of lag time before people run out of cash or credit card room and start adjusting their payments. But 2/3 of Canada's economy is consumer spending. That's pretty normal in the Western economy. But when you take $2 trillion worth of outstanding mortgage debt and you over double the interest rate associated with that, so you knock $1,500 out of everybody's capacity for spending monthly, that's going to impact. Like, look at what they do when they give a $500 check for one of these things. All of a sudden, the next month, GDP's up. Like, it actually helps the economy. It's $500. Well, minus $1,500, and don't just do it once, do it every single month indefinitely. It's going to hurt. It just hasn't happened yet. We haven't got there. Half the variables actually go up. So people that have taken a variable, slightly under half the people, and then slightly under half of those actually have their mortgage payments go up. So if you have a Scotia mortgage, for example, the payments go up. If you have a TD mortgage, the payments stay the same, and then your amortization changes. And then people hit their trigger points. The trigger points mean the bank has to get you back in line so you're not going negative every month. But it doesn't actually require you to get back on your regular amortization until you hit your renewal date. So people think, I've had to raise my payments $240. That just stopped you from going negative. You still have a 9,000-year amortization, and you're going to have to get back on your 15-year track once you get your renewal. So yeah, there's a big lag time. And when it impacts, a year from now, we're going to be getting closer to half the people in there. The Bank of Canada is going to know the impact of that and probably start adjusting. But I think one thing that they are aware of is that so many people bought real estate in 2020 in this. Yeah,
that's what I meant. So if you look at there, like the dip is kind of like by end of 2020 around that. And so this if you put 5 years, that would be kind of 2025, 2006. Yeah. And then I just get concerned that they're going to be crazy.
They are finally paying. Even the media is now paying attention to the mortgage cliff, right? Like, what happens when all of those mortgages that got extended at anywhere from 1.5 to just over 2%. When those mortgages got taken out and at these super high values, when those turn over from a 1.49, if rates are still at 5.5, like that's going to be excessive. So right now we've got some room, but that's not going to last forever. Because if you got a mortgage 5 years ago, your rate was 3.79, so it's kind of at a previous peak. So 3.79 to 5.5, yeah, that sucks, but it's not like 1.5 to 5.5. And I think that's one of the reasons they're continuing to be pretty aggressive right now instead of waiting, because they really want to take care of it before we hit that cliff. Because that will then, like, it's not, even if people were responsible and said, okay, well, we're just going to tighten our budget and figure it out, well, then they're not spending money. And then the economy starts collapsing kind of backwards. Car salesmen are out of work, and then carpenters are out of work because no one's renovating their house. And then, like, the guys selling carpenters' clothes are out of work, and the accountants are out. Like, it'll spiral downwards very quickly once, like, if something like that hits. So I know they're trying to balance that, but I think that's why they are being aggressive, which is probably the right move. They should have started a year earlier, and then we wouldn't have to be at 5.5 right now. But yeah, so good question, long answer. Don't ask me to predict what'll happen with rates, but I've been consistently wrong. So, as most economists have been. So I do know eventually it's unsustainable. Like, people can't afford these rates at the current, there's just no way they can actually afford it once they turn over. So
generally there's a long-held belief that in Calgary condos, apartments, these are good investments. But looking at the year-on-year increases and then looking at the trends that we've already discussed, how do you look at it now?
I hate condos. so starting with that base, a rising tide lifts all boats, right? So if you bought, if you would have asked me 10 years ago if you should buy a condo in Toronto, I would have told you not to, and you'd hate it. Right? So because it's condos, you don't really own land, you don't you own a depreciating asset, which you can actually write off, because even the government's like, yeah, you just own a building, it's going down in value. It's like a motorhome. So now, having said that, a rising tide lifts all boats. So prices are 2.5 times thing. It's like, yeah, your condo's still a place to live and it's going to go up in value. But once that building's 50, 60 years old, you're going to be paying $1,400 a month condo fees just to maintain it. Setting that aside, condos in Calgary, we're running, it's not because of Calgary specifically, it's because we have the ability to easily build elsewhere, so we don't need to just build condos, and we have the #1 traffic in the best traffic system on the planet, basically. Our traffic is better here than any other major city in the world. So you can live in Silverado, Legacy, or Seton, and be downtown in 40 minutes on an average workday. So someone might debate me on that. I don't live downtown, nor do I go downtown.
Takes less than that.
Yeah, okay, less than that. Yeah. But you can't. If you tried to do that in Toronto, it would be 3 hours. In Vancouver, it would be 6 hours. I knew people who used to work shift work in Vancouver, and they would work 12 hours on, 12 hours off, and they just bring their camper and sleep in the parking lot. Because it's not worth driving. Because why would you drive 6 hours and then drive just to basically get not enough sleep and then just drive back? So they just bring their camper, hang out, and that was years ago. It's worse now. So that is something particular about
one
Calgary.
advantage, and the other one is the interest rate coupled with the demand rate. Because as interest rates keep going up, that's actually driving the apartment and row house sector. Because of qualifying is really tight now. So it's not like the demand is disappearing. The demand is actually getting worse. More and more people are coming in, but then the qualifying is really tight. So most people, they just end up going to the apartment and townhouse sector, right? Now, we hate condo as investors, but most people are not investors, right?
Yeah, if you've always lived here, you don't understand the difference, unless you're from New Brunswick. You can ignore all this because it's different there. But if you're from people here think that you should, I finished school, I'm 22, I should be able to start at the finish line and buy a single family house. And it's like, that's not what happens in Toronto or record. You don't like nobody gets to start at the finish line. It's just we've become entitled to that because it's been so easy for so long. Normally, you've got to start. You got to buy a condo, build up some equity, then buy a townhouse, then buy another townhouse, then buy a semi-detached. Then maybe when you're 60, you buy a single-family house just in time to retire. But that's not like. But here, everyone's like, no, I can, I'm finished school, I've been working for 3 months, I'm gonna buy a single family house and they can afford it. So people have been somewhat spoiled. So yeah, now that the rates are compressing that qualifying capacity, even though we have good incomes here, it is actually driving. Like that's where the biggest increases are in condos. We had a lot of condos too. The problem with condos is when you build them, it takes 6-7 years from the time you have the idea of it until somebody's moving into the first unit. So when the market turns, if the market's really strong and then it turns, you got 6 years to it's too late. You've still got 6 years of let's say, in 2007 or 8, you realize, oh no, we shouldn't be building condos in Calgary. Well, you're still not finishing until 2012. You're still building and adding new inventory, even though Calgary doesn't need new inventory. Those properties, the Heritage, the Life of London, whatever, towers, huge in 2006, 7, there was huge, 2008, maybe, I forget what possession now, maybe 2010. Those are still worth less than people bought them for 15 years ago. So, that's somewhat, I know the market's been flat, but in spite of the recent increases, they're still worth less. But that's the dynamic of how condos are built versus other units, where single family houses, it's okay, well, stop building houses, and 9 months later you're done. So
and down the road, when rates eventually come down, we might actually end up with an oversupply of condos, because right now there's tons of downtown condo projects going up, and they're not going to be done construction for another 3 to 4 years, right? So right now there's tons of buyers, especially from out of province, buying these pre-construction condos, right? And we don't recommend them. The one look at the price and we're like, you know what, you better run, right? don't buy these. But in spite of our advice, people are still buying those. They're still signing on those contracts. And we've actually had buyers who bought with different realtors, let's say 3-4 years ago, come to us. They're, hey, supposed to close in 2 months. Can I sell it or can I flip it before I sell it? And I'm like, unfortunately, you're probably going to lose money on this on the resale market.
Yeah, just give us $80,000 and you can flip this thing out.
And we've seen it. So it doesn't work. It's great right now. If you have a condo, if you want to offload a condo, it's a great time to do it right now, right? But for the long haul, we don't recommend a condo.
What about all of these factors impacting new construction? Rebuild. What do we call it?
Yeah, new construction.
Yeah.
I think you're talking edge of the city versus inner city. Is that they're trying to keep up as much as they can. Mm-hmm. Not to mention the municipal government for a decade plus has been really looking at Calgary as a whole and thinking it's too expensive. We keep building out because that's what people want, of course. But it's becoming too expensive for a city. It's environmentally not great. It's so they're really trying to force density. And now the overall zeitgeist of the time is more density, walkable communities and everything. So they're getting away with pushing more dense zoning more and more than they used to. They used to all know it was necessary, but none of the councillors were willing to do it because they were scared of the backlash from their constituents. So that's now changed. But I do think that we're headed that direction. Whether we like it or not, that's the direction that all municipalities are going everywhere across the country. And in Calgary in particular, we're a very large city in footprint. The amount of people we have, we're probably 3 times as geographically large as most cities our size. So we're going to get more density. And so the government's pushing that, making it more expensive for builders, and the cost of labor's gone up significantly. So it's very challenging. I'm not a big fan of new builds, not great rentals. And in a downturn, you're now competing with the regular people who want to sell their house, plus you're competing with the builders who have a lot more inventory. And if their prices are going down, now you're competing with them, except your house is now 3 years old or 5 or 6 years old and dated, and 6 blocks away, somebody can buy a brand new house for the same amount of money. Sometimes builders will actually sell it at a loss because they have to stop the bleeding. They paid for all the roads, the deep services. They'll sell at an actual loss on a sale because they need to stop the bleeding of the back end. So that becomes your competition. If you're buying a house in, Acadia that's fully renovated, or a new duplex somewhere in Highland Park or Killarney, you're not facing that same dynamic.
And I'd also kind of caution against buying legally suited new construction properties. Not to say that they're bad, as an investment, they do work in some cases in some neighborhoods. But the risk is we don't think they're going to be very resilient in the long run, especially if the rental market takes a downturn, right? Now, if landlords start dropping rents, now you're competing against your whole street with the exact same floor plan. And you guys all have the same basement suite, so you're going to be undercutting each other, right?
And you're buying in a ghetto. It's new and it looks really nice right now. But eventually what happens in rental neighborhoods, the renter doesn't have a lawnmower. Then 3 houses down, they don't have a lawnmower. And then what happens is once you get, every third property not mowing the lawns, well then everybody gives up. The weeds are everywhere and the houses start getting run down because the landowner, the actual owner is only there every couple of years. The siding starts peeling on their smart board and they don't bother getting it painted. So now all of a sudden it just becomes a rental community kind of ghetto, but at least it doesn't even have, at least if you're in, Killarney and there's some old junker houses, next door there's an infill too that they just sold for $1 million. So there's that kind of competing price and incentive because of the proximity to downtown, the nicer amenities, and you don't need a car. But if you live in Seton, you need a car. And then of course they don't have the same amount of parking as older neighborhoods have because they've really narrowed out the lots to maximize houses and minimize streets. So they just don't have the same parking. And so those are going to be it's going to be 30 years before transit gets up there in real capacity. So not a big fan of anything on the edge of the city strictly for investment.
Now, on that kind of same note, where Layne was saying properties get more and more rundown over the years, a similar one would be townhouses or row houses with no condo fees. You'll see these being popularly advertised by builders, and of course, there's no condo fees, so it's very attractive, right? At face value, but then you have to remember somebody has to maintain the structure of the building, the exterior. Who's doing that, right? Oftentimes, these get run down way faster, and because you share a roof, it's even worse. If your neighbor doesn't want to pitch in for a roof replacement, you're kind of screwed. Now the structure is getting ruined, right? So we've seen people get caught in that as well. So just a word of caution.
The best example used to be along 64. I don't know if you're familiar with 64, right across from that, kind of right before Deerfoot. There's 4 plexes, and there were 4 corners owned, so every one individual title had no condo fees or no agreement of any kind. So you drive in, and they were only maybe 20 feet and 20 feet of each house, so they were 40 by 40 with 4 units each, so they're really small. And then you'd see half of one painted, half of the roof shingles done, then the other one was orange, then the other one was run down, and the other one had a new fence, but 15 feet of new fence, 15 feet of an old falling over fence, and then grass growing up. It just looked, if they were all terrible, it would have looked better. But the fact that some people were trying to upkeep them actually made it worse. So it's a perfect example. Somehow they cleaned it up. I think somehow in the community they must have gotten together.
That's the green and yellow siding.
So it's a good example of those neighborhoods that are built for rentals but not designed for it because there's no common. There's nobody to force them to mow the lawn. Eventually you can call the city on people, but that doesn't make them take care of the painting, the exterior, and keep the weeds out of their garden and stuff like that. So I don't particularly but they were I think it was one that went up for sale. I won't name the builder. You know that I don't like them because they've been doing this for years. But I think they had 18 go up for sale one weekend. They sold one to a Calgary buyer and the others had for Paul from Toronto. It is because they were for us they were $100 overpriced. We're stay away from that. That's garbage. People in Toronto were my God, that's so cheap. That's the cheapest thing I've ever seen, and they bought it. So yeah, it's a weird dynamic to see people from Toronto come here because we have to really talk at the top of the ledge. Like they're willing to throw money thinking, it's real estate's always going to go up, and essentially they've been a little bit correct for the last year or so, but we still want people buying with strong fundamentals.
Yeah.
You say it was low inventory right now.
Yeah.
Is that because lack of workers or?
What do you mean? What?
Housing inventory.
Yeah.
Yeah.
Well, so I'll speak a little bit about that. As interest rates have started going up, the inventory problem is getting worse. Because the problem is, when they sell, they got to go somewhere, and usually they're either upsizing or they're downsizing. Now, if they're downsizing, great, you could probably qualify. But for a lot of we have a pretty young kind of population. Yeah, young population. So a lot of them are trying to rather upsize. But then what they're realizing is, if I sell it, I can't requalify for a bigger house because that's not going to work. So they're either staying put. That means now they're just holding back, waiting for rates to come down.
Oh, because nobody's selling.
No one wants to sell because the rates are the way they are.
Well, yeah, we just have. You saw the ones that 60,000 people move here in 3 months, and let's assume that's let's assume that's $100,000 per year, or that are coming to Calgary, or even 60 a year just coming to Calgary. Well, we're not building enough homes for that. We're building enough homes for maybe 25 to 30,000 people if you count, I think, 2.6 per home. So yeah, we're not building enough homes. We're already out of inventory. Rent. If you look at the rental market too, it's the same thing. Like people are getting like $1,700, $1,800 for basement suites. Like 2 years ago, it was $1,400, $1,500 for a main floor, and now we're $1,700, $1,800 for a basement suite. It's not because they're worth that. It's because there's nothing else. It's either that or they go to the homeless shelter with their family. Like it's again not a lack of money. It's that there's one house available and 10 families looking for it. So rents are really, really high, excessively high. So like I renew everything in this time of year. So I have like 27 sets of tenants that I've renewed this year, and I think 4 are moving out. So that's it. Like the other ones are all either can't buy, or there's like none of them can still find anything else, even if
That's just in Calgary, right? No,
correct.
yeah, that's not
Yeah, and I would argue because of 1 million new residents in Canada, well, 1 million in 2022, another 500,000 so far, 500,000 to go. That's pretty much what it looks like across the country. It's just really bad. Like 1.5 months of it. We were 6 months supply a few years ago. And that's high. That's the wrong side of that's a buyer's market. But I mean, what's a seller's market between 3 and 4, where it kind of shifts? Balance to 3 and 4. Less than 3, yeah. So we're not even half of what it would. We could double our inventory and still be a seller's market.
Like just that year over year, almost 45%. It's nuts.
Yeah.
Markets.
Yeah, it's just this is going to drive immediate prices up, but it's also it's also not going to get resolved anytime soon. You can't build fast enough.
What kind of properties and which parts of the city do you recommend invest?
Do I particularly like? I like houses with basement suites because that's where you get better cash flow, 95% of the time. You also have like a larger chunk of land as compared to anything else in land is part of real estate that goes up in value. So
Is there a specific community that you
communities, I like kind of the mid-range communities. So I would say
That's a whole presentation.
yeah. That's
We probably won't get into the weeds of it, but
I mean, you like Boness. That's kind of a unique community itself, and it's quite a large one. She likes Boness too, or doesn't like it. I'm not sure. I mean, I like the North Central corridor, so like Huntington, Beddington, Thorncliffe, Highland Park, Greenview. Right, they have really good transit, so it's great. Like they're doing the Green Line up there, but there's already express buses that are full. Like it's already great for transit, and a bunch of roads downtown, so it's really good that way. In the south, there's like
Ross Carrot.
Yeah,
Glenbrook's a bit more expensive.
Yeah.
Morgan, Glendale.
yeah. I've got a bunch
Southwood.
myself in Southwood, and then there's Acadia more expensive. Fairview is actually kind of a sleeper neighborhood where I feel like it's actually closer to downtown than Acadia.
They don't have too many like semi-detached. It's mostly all
Yeah.
detached.
Yeah, same with Acadia though.
Same.
Like there's some, so it's kind of those areas that are, how old, I guess 70s, 60s,
60s
70s.
and 70s.
Yeah, those areas, maybe 50s even. I mean,
We like to call them the sweet spot neighborhoods. Like they're not like 50s and 40s where there's tear downs, but they're not like newer than that.
Yeah,
And they're classified as a B neighborhood, right? So it's not an A neighborhood where the purchase prices are really high and you're getting negative cash flow, but it's also not like it's not like Forest Lawn, right? Where it's necessarily way cheaper and you're gonna cash flow a lot more, but then the tenant profile's not that great, right? So we like to recommend that investors buy sweet spot neighborhoods. Yeah.
and it depends what you want. Like if some people I've got a client who loves Forest Lawn because that's where the cash flow is, and he's okay with but that's what he does for a living. He's flips houses. He's one of those we buy houses people, but spends a few $100,000 a year and negotiates. So I don't recommend flipping either, but that's what he does for a living. But he just loves Forest Lawn because the cash flow is really good. I like some potential upside in my properties too, to be able to either sell it off to a developer or redevelop it myself to something. And that's why I like single family houses, because you get a big chunk of land with it, and if it's in a good enough neighborhood, then you can redevelop that into something better. It's those are the neighborhood. There's ranch lands will probably fit into that kind of
Yeah.
there's a handful of neighborhoods close to transit always helps, especially with transit being pushed more and more. The Green Line's going to go ahead probably on the first now, which is good. I didn't do that because I'm smart. I got lucky on that particular part because I think every property I own in the north is within 2 blocks of where that Green Line's going to go. So got lucky there, but then in the south there's already transit going down.
Yeah.
Yeah.
So
We'll do a presentation on it.
Yeah.
With the basement, I mean, you have to make a door on the side to make it defense. How much permits do you need to get before you do that?
I'll leave that to him. He's done more of that. I hired someone to do all my suites.
So-
That's the details.
So you're asking just to add separate
So if you buy a property, right,
Yeah.
and you have basement,
Yeah.
you renovate the basement to make it a different
a suite.
suite.
Yeah.
But you need to build a door on the side.
Yeah.
What kind of permits do you need?
Are we talking a 2-story and you have to do a walk down?
Yes.
Yeah.
Okay. So those get very expensive, and we often discourage investors from buying 2-story without a separate entrance, right? You can ballpark, if you have 8 stairs, it's gonna run you about 18 to 20,000 just for your entrance. Okay. Oftentimes, by the time you work that into your numbers, it's probably not going to be a very feasible project for most people, or make sense from an investment standpoint. Which is why we always recommend buy the 60s to 80s buildings, because they typically have a back door or a side door,
Side door, sure.
or a bi-level style, and you can just split the entrance rate, and then you don't have to cut out holes in the entrance.
With a high interest rate and low inventory, what is the price range that has less competition among buyers? Because I think nowadays we still bid for house, right?
Yeah.
And we can't have conditions like inspection, something
Yeah,
like that.
so in general, under 500,000, I'd say it's red hot. Okay, so if you have any conditions at all, it's getting very, very challenging to make that work. The price point where you can actually, put in an inspection condition, financing, do a bit of negotiation is over 800,000. Okay, so these are the bigger properties, right? And that's where the buyer pool is way less, so the sellers are willing to do some negotiation, right? Anywhere in the 600 to 800 kind of depends on what the attributes of the property. If it's a
Like comparison with the benchmark here,
Yeah.
detached price. So for houses with 800, more than 800,
Yeah.
is this the price growth is less or it is more than the
Yeah, the benchmark. Yeah, so they are going up in price, but they're not going up at 8% rate. Don't quote me on it, but I believe the over 800K range is only going up to about 1.5% versus 7.6. And these price gains are mostly driven by in the lower segment of the market, right? Yeah.
It seems because the lower you go, the
Harder it is.
like if you've got a small half duplex, like we got one in Therrien-Bernard, I hate flipping, I'm flipping the property right now, but like we're just shocked with like that I own properties that are similar to this building. It's a very small side by side duplex, and I know what they're worth. And it's like I just like every time we look at new stats or new sales, it's like again it's like $100,000. Like what would sell for $240 a few years ago is going to be $340. Like that's a massive percentage increase in a very, very small. But that's like so it seems that the lower you go, the hotter it is because that's all people can afford. And then once you switch into condos, it adjusts things a little bit. But it's why for the first time in Calgary, condos are actually going up in price and you know, you got rid of a lot of inventory. So
Yeah.
So with the net migration that is sort of projected to continue to Alberta over the next several years, sort of imposing a cap on the cost of, etc. I guess rental prices have been rising for the last 6 months to 12 months. Do you think that those, like it seems crazy, but do you think those market rent prices are going to be sustained for a long time now? Like, do you think they'll come back down? Do you think they'll stay?
that's a good question, and Anthony and I talk about a lot. Like there's like certainly $1,800 for a basement suite isn't reasonable. It just doesn't even make sense. Just that that's what's available. So I think some of them, especially excessive ones like that, are likely to come back down. I do think that because rents popped up so much that if the the rate does come back down relatively quickly, that rents could come down as well. But it does depend on how much inventory there is. Like if there's a lot of inventory, rents are going to come down because people will be looking for cheaper housing. It's and often what happens if inventory shows up is people renting a basement suite are like, well, for another $100 a month, I can rent the main floor now, and it just slowly peels its way backwards. So we have seen big drops and fluctuations in real estate before. Again, I think our economy is a little more stable than it once was. So I probably less so, but I mean we saw like a 20% drop over a few years, one time. But that was really after a 20% increase too. So it was a 30% increase and then a year later a 20% drop. But it's a good question for right now. We're having a 30-40% increase. Is it going to be sustainable? I'm not counting on it. I'm kind of putting a buffer in there to make sure, but hopefully rates will come down before that happens too. So it'll still be a net positive gain. But yeah, I don't think it's necessary. It depends what you're getting. Like it really depends because right now I know I'm like I'm increasing my rents to around $2,000 or $2,100 for my 3-bedroom main floors, which a few years ago were $1,500, $1,400. But I know if I look at my competition, it's like $2,300, $2,400. Like I could easily just say that, and if they didn't take it, I could rent to something else. I'm not, so maybe that's part of me not wanting to get used to higher rent too. Like I'm kind of building in that I've got a good tenant, I'm trust them, I'll keep the good tenant and not worry about maximizing rent for 1 year. It's because I do think that is possible, but rates I think would have to come down at the same time because if people can't afford it, they're going to sell. But it's and I think there's enough strength in our overall market that it's likely that's going to happen anytime soon.
I don't think it's ever going to go back to where prices rents were like 2 years ago.
No, it's just a bit of inflation there. I mean, the federal government for over a 12-month period printed 27% more money to represent the same amounts of goods and services. That's the definition of inflation of 27%. It's worked its way into all markets at different paces, but it's certainly in the housing market and now it's built into rents. That's where things are going. I mean, you see the labor now catching up to it as well. So
But I think rent prices aren't reflective of like the interest so that
For sure.
you have like people who live in the city, and there's no consensus, so whether it's affordable or not, like they're gonna have to get roommates, they're gonna have to downsize their,
Yeah.
right, that they're not gonna make one rent to 2 bedrooms or whatever, so.
But it does impact, if I can't rent it for what I'm, if I get to lose $1,000, I'm not gonna buy a property, or I'm gonna sell a property. So then that will impact the supply, so it will, so that the interest rate will, certainly not right away, but it does impact what people can do. And it's impacting us now. Less people are able to buy rental properties and put them on the market right now because rates are higher. So, yeah, but you are right. Yeah, if there's inventory out there, people like a renter is it going to be like, oh, I could go rent for cheaper, but since your rate's really high, I'll keep overpaying you rent. They don't care. Just yeah.
First of all, I'm not an owner, but my question is now, as a buyer perspective, it's a good time to buy. So, how about the selling perspective or investment perspective? Is this a good idea to sell property now based on the interest rate, or it's a good time to refinance our property?
Very hard question to answer.
Yeah, it would be specific to your
Specific
circumstance.
to your circumstances, but if you've had a property for a long time, let's just say you're getting close to retiring, you want to get out of the game, then yeah, it's absolutely a great time to sell. Especially if it's in the under 500 range, because you're going to get probably more than what you had in mind, because that's just.
Or if it's like a beat up property and you're like, I've been wanting to sell for years, but I have to go in, renovate, clean it up, replace the kitchen right now. So you list it, some young investors will be like, let's go buy a house and renovate it. Like it's a perfect time to sell your junk too, right? Or something that you knew would, is going to require some work because you won't have to. If you have no other reason to sell, then yeah, I still think the fundamentals support a strong market here, stronger than we've seen over the last 15 years, and I think it'll be more consistent than what we've seen over the last 15 years too. Because we've had some, booms and busts, little mini ones, but I think this one will be kind of a more sustained growth. And I certainly don't think these, like the price increases that we've been seeing are going to connect, although I don't know, the inventory levels where they are, it's going to be a little crazy for a while. But it takes something for people to get used to the prices. And in spite of the fact that we're still quite affordable, everyone isn't moving here from Toronto. Most people that are buying have already lived here, and I think people are just like, no, we'll stay in our $600,000 house. Like, that's absurd that we're going to get for that. Like, I just think there's a certain mental block that is not going to cause a 6-month massive spike, but I do think it's just a really strong market. Like, our sales were, like, one of the struggles we're having right now is that our spring market has been, it's like every third buyer doesn't buy because they, like, even once we get them qualified, which is challenging in itself and fun to get them qualified, they go right 5, 6, 7, 8 offers every week and they don't get a house. So it's like the spring market's not over. It's this people, the spring buyers are still going to be buying in the fall because they finally found someone. Like, and that's, like how long have we worked with some of their clients? Like, it's been 7, 8 months that they've been ready to buy, and like actively out, like, oh yeah, they're going to buy this weekend. No, they're going to write offers this weekend. They're not going to buy anything. Like, that's what's happening. So there is some sustained, like, because normally, like, that's why it's a July record, for a variety of reasons, but a lot of it's because those are, April buyers just couldn't find anything yet. They're still in the market looking. And it's like
with one client, you'll probably know who it is, but I think we're close to 50 offers, failed offers at this point. We're still going, but yeah, that's
it
the way the market is.
it is challenging because in this type of market, as a seller, no, I don't want conditions, but the buyers, it's harder for them to qualify. The rates are high, and it's like I
can't take risks.
Yeah, you can't take a risk. Even if there's like a 2% chance that you write unconditionally, you can't go. Like, you're losing your full deposit plus you can get sued.
Okay.
So it's like, if there's a 2% chance it isn't going to work out, you can't write unconditionally unless you've got a really strong backup offer. Parents that theoretically could qualify if necessary for whatever reason. So yeah, it's the market's really strange and challenging for people.
Based on your
Last question.
Yeah.
based on your experience, what do you think when the market will change?
Anywhere from
I'm gonna record it
6
that way.
months from now, 6 months to 20 years.
Arrange.
Yeah.
Wait, what does if you don't get married?
What's that?
Finally, will change.
Yeah, it will change at some point.
Yeah.
We can't time it. We don't have a crystal ball.
Yeah, but that is it's actually an important question because it really you can't time the market. Like it is impossible. And this is people were waiting for our market to drop from last October, November, December, we're waiting for the market to drop because it dropped everywhere else. And it's I don't think it'll drop here. We're starting in a really low base. We Toronto, Vancouver were already excessive and then got a little more excessive. We finally came off at 20-year, that low, and then finally came up a little bit. We don't have room to drop, and all the fundamentals were still strong. It's so I'm by the time you realize we hit the bottom, or there's not going to be a bottom, it will have hit. So you've already missed it. So just go out and buy a property that fits when you're ready to buy.
If you
Yeah. So when you're ready to buy, and you find a house that fits your criteria, that's when you buy instead of trying to time the market. Nobody can, in whatever market you're in, whether it's stocks, houses, there's just no perfect timing of it. So
What's your opinion towards short-term rentals?
I don't it's another job. So I might as well just get a regular rental and then get a part-time job on the weekends. That's my opinion of it, because then you can quit, schedule your hours however you feel like it. But I do know people that have made money at it, but it is just it's like a part-time job.
But from an investment perspective, how well does it perform?
That's what I'm saying. You might as well get a part-time job. It's not better than that. So just buy a regular rental, rent for the same amount. And it doesn't. Any market where you make too much money, everyone will do it, and then the market will even it out. So if there's tons of money to be made doing short-term rentals, well, everybody's going to start doing that because it's easy. It's especially in a market like this, all it takes is a couple of 22-year-olds that want to do it, and they turn it into a job and make a ton of money at it, and then there's too many of those, and then the rents come down.
We're noticing the short-term market is starting to get a little saturated at this point. So if you're going to go into that space, do a little bit more due diligence.
Yeah, and make sure whatever you're buying would also just be a good regular rental too. So